Good afternoon. Thanks, Alessandro. My name is Quentin Hyam. I joined the business in May 2020.
And my name is Tom Carter. I joined the business a month later in June 2020.
Alexander, if you can go to the presentation, please. Thank you. So we've just done a quick introduction. My background is predominantly within the sort of beauty personal care space, with the exception of 3 years as a brand director at Swatch. But I've had a number of sales, marketing and executive roles at Revlon, Coty, KMI and latterly with Yardley Wipro.
And I started out training as a chartered accountant with PwC and then did a number of roles within commerce and industry. Most relevant to brand architects was my time at Procter & Gamble and Alliance Boots. After that, I worked at a leading mid-market hardware technology company, Technetics, before joining Brand Architects in June last year.
So this slide basically summarizes who we are as a business. On the right-hand side, you'll see our brands. So the female brands are in the top half and the male brands in the bottom right-hand corner. We are an outsourced business. So for those of you who know us, we were a carve out of Swallowfield, which is a contract manufacturing business. We outsource all our contract manufacturing, but we specialize in the sales and marketing of beauty personal care brands. For those that you've seen before, all those brands you'll recognize. The one new one is the Unexpekted store. So that's the launch of our marketplace, which happened earlier today. What we're very excited about is bringing all of our brands into one place. And our proposition is about exceeding expectations of everyday beauty. So I shall give you the financial headlines for the year, which closed at the end of June. Net sales were 15.9, which is a slight decline on last year of 2.5%, which was a resilient performance given the pandemic. So we were affected by store closures or decline in footfall. Overall, the group's underlying operating loss was 300,000. However, that had absorbed into it our first ever above the line campaign for Superfacialist, which has been our star performer. The brand has grown by 30%. Net sales. However, the group also had a strong net cash position of 19 million, which is a £1 million improvement on last year. So really this year has been about putting in place transformational strategies, and we addressed 4 key strategic tenets. So one was optimizing the portfolio. So that was really looking at the number of brands and the number of SKUs. Channel development, which is about distribution gains, operational efficiency and being a responsible business. So from a productivity perspective, we've reduced our live brands from 22 down to 13. We launched a new brand called The Solution, which went into Superdrug in August 2020. And we put in place relaunch plans for 7 other brands. And they are all hitting store as we speak. So through September and into October. We did secure multiple distribution gains, in particular on Superfacialist. So that launched into Waitrose and secured distribution at Morrison's and Tesco at the end of the financial on the back of the advertising. Some of our other brands performed well. So we got Dirty Works was listed into Walmart Mexico. Happy Naturals launched into Carrefour in Qatar. And we also saw The Solution, Dirty Works and Superfacialist all launch into Douglas.com in 4 or 5 European countries. Our D2C business, which has always been an Achilles heel because it was such a small part, did grow by 100% to 600,000. However, what we're most excited about and what we've been working behind the scenes is we've just launched the Unexpected store, which I'll explain a bit more in detail. But that's a 5-year agreement with TXG Ingenuity.
So now we're going to talk through some of the financial highlights. So these are our 6 KPIs, and what I'll do is I'll start on the top left and go around in clockwise fashion. So from a net sales point of view, as per the previous slide, there was a small decline year on year from 16.3 to 15.9 million, albeit a very resilient performance considering the headwinds that the business faced. So in the next slide, we'll actually go through a bridge that will take through the ups and the downs versus last year. Then we go on to underlying gross profit margin. So what we've done here is, rather than taking our statutory gross profit margin in our accounts, what we've done is we've stripped out in both years any exceptional items that have gone through cost of goods to show the underlying performance of the business. So what you'll see is there's actually been a good margin improvement year on year. And that was partly driven by better product mix and also better channel mix, in particular on e-tail and D2C, that have shown good forward movement on our gross profit margins. On an underlying operating basis, we made a loss of 0.3 million. And as Quentin referenced in the previous slide, the main change really being the fact that we chose to make a strong investment for the first time in a TV campaign for Superfacialist in Q4, and that was absorbed into the P&L in that period. The small decline in sales was actually offset by better product margin. So really it was just that change in the cost base of the marketing campaign, whilst all other costs remained broadly in line with the prior year. From a PBT, profit before tax point of view, the group made a loss of 1.9 million. The difference between that and the underlying operating loss was a partial write-down of the intangible value from male styling brand Fish. So Fish, being in the male styling market, was affected by changing consumer habits and also a loss of footfall in the high street where the Fish brand is sold. And so therefore, from an accounting perspective, it was necessitated that we did a partial write-down. However, that doesn't dampen our enthusiasm for the brand or the fact that it's very much part of our future plans. Net cash was up 1 million to 19 million. We've got a slide on that as well, and I'll take you through the changes within that on how we strengthened our cash balances further. And then on the far right-hand side, direct-to-consumer revenue. So this is on our own e-commerce sites. We managed to double revenue, albeit from a small base, from 0.3 to 0.6 million, setting us up now for exciting plans, as we'll take you through on our marketplace. So this is a revenue bridge that takes us from prior year revenue on the left and the main changes through to the year just gone, financial year 21, the 15.9 million revenue. So if I start from the left then, the key drags versus the prior year were, first of all, some one-off income from an IP coexistence agreement that the group signed for its previous brand Alive. And then some deficits in terms of the impact of COVID on the business. So first of all, a 0.6 million decline on particularly our Christmas gift range. So the retailers, in light of the pandemic, reduced their range of Christmas gifts in store for the Christmas just gone, Christmas 2020. And that had an effect on the Christmas gifts that we were able to sell into those retailers. And there was also a 1 million decline, mainly due to the high street channel. And that was due to the pandemic-related lockdowns that reduced footfall in those channels that had an associated decline in our sales volume. However, we did get some upsides. We were able to partially capture the change in consumer buying habits in both e-tail, that had a 0.5 million increase revenue for us, and D2C, as we discussed in the previous slide, going from 0.3 to 0.6 million. And then on top of that, good performance from our skincare brand, Superfacialist, that drove outside of the e-tail and D2C channels an incremental 0.5 million in revenue, taking us to an end financial result of 15.9 million in net sales. So from a cash perspective, we closed last year with a 21.2 million in gross cash. So that's cash before taking into account debt. We elected to repay our remaining term loans, the 2.1 million, and also outstanding invoice factoring, as we didn't need those as part of our funding structure for the business. So that took us down to our 18 million net cash start point for the year. After there, in terms of pension, we continued our scheduled payments to our defined benefit pension scheme, a closed legacy scheme that we continue to pay into. And we also made targeted investments in our D2C marketplace and also in our IT systems, key parts of our strategy going forward. On the upside for cash, we had a very good sell down of our inventory, getting down to what we think is a good lean and mean weight for our inventory balances versus the prior year. And that very much drove a very positive working capital inflow, the 1.2 million through to cash. And we also had repayment of tax previously paid on account that was repaid to us by HMRC during the year. That took us to a strong closing net cash position of 19 million.
Thanks, Tom. So our strategy has evolved. So this is the 5-year growth plan. There are 4 pillars to it: brand development, brand reach, environmental and societal responsibility, and a new pillar called the Unexpected. Previously, we had a pillar which is operational efficiency, and that was as a result of the carve out from Swallowfield that we really needed to set brand architects and therefore invest in things like demand planning, use of business intelligence, consumer dashboards. All of that has now happened. So rather than having operational efficiency as a pillar, that's now the foundation on the business from which these new 4 pillars can flourish. So brand development is very much about listening to consumers and customers, making sure that our product portfolio meets their needs, that not only from a new product development perspective, but also from an aesthetic. And there are 5 drivers that fuel into brand development. So productivity, new product development, becoming a digital first business, advertising and promotion, and then M&A. Brand reach, and we'll mention this quite a lot, which is reflecting how consumers have changed their habits, which is distribution. So, we need to be available wherever she or he wants to shop, when she wants to shop, how she wants to shop. So it's important that we implement strong distribution drives, both from a UK omnichannel perspective, the launch of our own marketplace, and international. Environmental and social is more about what we can control. So we'll present with you 6 headlines regarding the use of material and from plastics, etc., and raw materials. And then the 4th pillar is called the Unexpected, and that's a transformational cultural piece that we're implementing about how we change and work. So first up, it's brand development. So continuing the theme that we've had from last year, which is productivity, this remains very important, that we improve productivity, that we constantly monitor how our SKUs are performing. This leads to better purchasing efficiencies. So you can see, ideally, higher minimum order quantities and therefore lower costs of goods. And by doing that, we'll address some of the supply issues that the overall industry is facing. Also, by having a productivity focus, that leads to an improvement in shelf position. So you could go from the bottom to mid, but also your online ranking. New product development is at the heart of any strong beauty personal care business. The year we've just had was more about relaunching underperforming brands. Now that we've done that, we have put in place 3-year new product development programs, so we know what new products will come out by brand for year 1, 2, and 3. Digital first, which you'd have probably heard many times. Historically, Brand Architects was reliant on launching exclusively within bricks and mortar, and therefore, basically, that once the product was on shelf, that was it. So it was for the consumer to discover it. We need to change. So the first thing is about launching our own marketplace, the Unexpected store, and that will enable us to launch products on our own website first, rather than being constrained by category build dates of our offline retailers. In order to be digital first, we need to make sure we have all the assets in place. So whether that's video, how-to demonstrations, but also it will enable us to do a test and play. So, ideally, we're looking at potentially launching products in response to the Unexpected community. So if they wanted to have a product such, for example, somebody might say, we'd like to have a pomegranate body souffle. We could look at doing that on a small production run that meets the needs of the community, but also we're not exposed to large production runs. So that's an exciting bit. The other bit for becoming digital first is that by having our own marketplace, we now have access to our own consumer data. Historically, we had to buy consumer data through the likes of IRI, or you get it from Boots or Sainsbury's. As we develop as our D2C marketplace, we can see exactly how she shops, what she wants to shop. And so, that's an integral part to what we see in the future. A&P, so as we've shown by the success of Superfacialist, when we get a brand of scale, we will then invest in advertising and promotion. Although we used TV for Superfacialist, that was really on the back of an opportunity we had with Channel 4, who have this a greenhouse facility where they invest the same amount of money as first-time TV advertisers. So we took advantage of that, and that did help drive Superfacialist's awareness, share, and as a consequence, distribution. Until we get to brands to reach that scale, we will continue to invest in promotions, both online and offline. On average, we work between 4 to 6 times per annum with savings of 25 to 33%. I mean, we are a masstige brand or masstige business, which means it's just a little bit above mass. So therefore, it's important that we offer our consumers a discount because our whole proposition is about efficaciousness at great value. M&A, Tom, do you want to?
Yes, from a mergers and acquisitions point of view, that has been firmly on the agenda this year and will be going forward. Within our Project 50 plan, there are 2 elements. One is we firmly believe that there's great opportunity for organic growth, but also that acquisitional growth can supercharge the revenue line further to achieve our goal of Project 50 million revenue business. So we actively look at acquisitions, but they need to be good valuations. We think they also need to be brands which we think we can develop, that need to be complementary to our portfolio and also consistent with our culture. We think there's a great play there, not only from an operating synergy point of view, but also from a revenue synergy to open up new channels and markets for our existing portfolio. The opening of our direct-to-consumer marketplace as well adds another string to our bow and an opportunity to see consumers on that marketplace, what they want, where the gaps are in our portfolio, and how we can potentially address those either internally through our own MPD program or through M&A activity as well.
On to brand reach. So we split this into 3. So from a UK omnichannel perspective, historically, Brand Architects had a number of brands that were exclusive to certain retailers. And that's great when you're initially launching them because you get the support of that retailer. However, it also constrains how big those brands can get. So to the latter part of the last financial, we renegotiated those exclusivity agreements so that from this year, we can secure additional distribution, which then will hopefully drive scale. So that's now the number 1 priority for this year will be to look to secure new distribution, not only on those brands we've mentioned, Dirty Works, Happy Naturals, Beautopia, Kind Natured, Argan, and Sensebar, but also the ones that are already in omnichannel, so Superfacialist, Dr. Salts. So that's going to be, probably the opportunities is going to be 2022 because retailers don't take on brands between October and Christmas. International, we have a 3-tiered approach. So we're working with a number of key retailers that have got strong regional presence. So for example, we've just started to trade with Normal, which is a sort of pan-European retailer for one of our value brands, which is Root Perfect. So that launched this month across the Normal estate. And there are a few other retailers that we're looking to establish those relationships with. We have a number of strong distributors, and we'll continue to invest time and resource and work with them. An example is Ireland. So last year we saw tremendous growth, and they showed great distribution gains. So Superfacialist, Dirty Works, and The Solution all launched into Tesco Ireland, Lloyd's Pharmacy Ireland, Dunn's and Macaulay's. So there are a number of distributors that we've highlighted so we'd further invest and grow with. We also have some developed markets and some maintenance markets. So some markets we don't necessarily put resource or energies behind. However, they are regular. They place regular orders once a quarter. We'll maintain those, but the message is really a fewer, bigger, better. So we'll be putting more of our effort into 10 highlighted markets. From the Unexpekted store, which is the most exciting thing we did last year. This is a new integrated marketplace. So all our silo sites no longer exist as of this afternoon. The Unexpekted store is in a partnership with the Hut Group Ingenuity division. It's on a 5-year basis. It's a revenue share. We're very pleased that we can take advantage of their logistics and warehouse facilities. Also, they have a well-proven e-commerce platform and will plug into their trading and marketing services. The thing about the Unexpekted store that we're most excited about is that the positioning of our products is what we call masstige. So it's not too expensive. It's closer to mass. That's generally a market that's underrepresented on a D2C platform. And we want to basically give voice to the everyday. So, we're excited about creating a community where the community feels inclusive. They have a voice. They can also talk to us about potentially developing products. We can then develop products for that community. So all the brands that we have on the Unexpekted store have been developed in-house for that community. And that's a real point of difference versus, bigger marketplaces that are essentially our e-tailers. So we'll be investing initially from October through to December on a trading level, and then we'll start to create the community from January onwards. So we'll be using marketing monies from a digital perspective. So we'll be looking at PPC, SEO, the use of influencers, Facebook and Instagram advertising. But because nobody knows the Unexpekted store, we'll be driving traffic through the likes of Superfacialist. So we will put together the marketing program around Superfacialist. They'll end up in the Unexpekted store, and then they can see the opportunity to cross-sell. We will then drive subscriptions. So one of the important levers is that we build our CRM, so our customer database. Once we've got that data, we can then start to have a dialogue and incentivize them and then start the community. So that really is the most exciting thing that we've been doing in the background, and it launched at this afternoon. From an environment perspective, so we focus now on what we can actually control. So as I said at the beginning of the presentation, we do use an outsourced model. So it's important that we work with third-party manufacturers that have strong ethical and sustainable plans, but we can't exactly control what their heating or use of water or electricity is. What we can control is the use of plastics and raw materials. So we're pleased that we've made some good inroads. All our products are 100% recyclable. When we started, none of our products used post-consumer recycled material. Now we have 87 products. We've removed all plastic trays from our Christmas gift sets. We've removed all acetate windows. All our single-use products are now using Forestry Stewardship Council approved card, and 22 gift sets will also be using FSC card. Where we're using natural raw materials, it's been important that we've got official accreditation, so we know they come from a sustainable source. There's no damage to the environment or the habitat, and that's in particular for brands like Kind Natured, Happy Naturals, and Scent Spa. In addition, we've looked at our packaging footprint. So historically, brands used to have as big a footprint as possible, and obviously the consumer backlash against that is a waste of card. So we've done initiatives, for example, on our Superfacialist retinol cards, where we reduced the footprint by 24%. So it's using 24% less card. On all our relaunch products, we have now done a clear traffic light navigation system to help consumers understand how they can recycle. The fourth pillar is what we call the unexpected, and that's the transformational cultural piece. And that's something that's a long-term vision for the business. So you want to challenge the expectations of ourselves and the market and how we market. And essentially, we want to be doing things in a way that is unexpected. So there's nothing to show today, but as we develop and grow the Unexpected store, hopefully we'll be able to do more things that will appeal to the community. The retail environment, I think some of it we've touched on earlier. So COVID and in particular the impact on staff in store resulted in a number of retailers putting back their category rebuilds. So as Tom mentioned, we had anticipated that some of the relaunches would be in store from May, June, but because the retailers delayed it, it's gone in store in September. And into the beginning of October. So most of the relaunches you can now see in store, but that did have an impact on Q1 sales. The change in consumer behavior is here to stay. So it is very much about an omnichannel approach. And although we've seen an uptick in high street sales, it's not quite to the levels of 2019 because consumers they're now shopping across the board. So brands and businesses must offer an omnichannel approach, which we're pleased that we're making progress on that. There are some short-term pressures which have been well documented. The cost of shipping containers from China, which impacts our Christmas gift business, is a one-time hit for this year. There are also some logistical challenges that you'll have all been aware of, in particular the HGV lorry driver issue. Longer term, as I said earlier, the omnichannel will remain. We expect consumers to be more demanding with regards to the experience and community engagement they get online and actually in store. We do believe post-furlough that there's going to be greater emphasis on those products that are both efficacious and provide good value, which is a sweet spot for brand architects. Brands will need to be very clear on their environmental and sustainable initiatives, as it's sort of a must-have, 100% availability, and personalization. So I think it's changed in terms of what was the herd mentality. Now consumers are wanting things that are more unique to themselves. And that's an important consideration in the community on the Unexpected store. Some product trends, products that address stress, wellness, skin sensitivity, they're things that we're looking at developing for the future. So we are confident that our brand reach strategy, in particular the Unexpected store, and our brand development strategy, in particular, the digital first driver, will enable us to compete successfully in the future. An outlook for the next year is we have implemented a full root and branch change program, and that resulted in transformational strategies. It probably took a little longer than we thought, but they are now complete, and we believe we're in a strong position for midterm. In response to the market, when we arrived, we realized that 7 of our brands were underperforming and needed to be relaunched. And we did that all at the same time. Normally you would stagger it, but it was good to, we took that pain. So I'm delighted that they are now filtering through in store, although a little later than we thought. We're confident that we've got the right platform and clear strategies for future growth to build success. When we wrote this, the Unexpected store is launching imminently. That's now today. So it will take some time and investment before we can share the upside, but it is an exciting tenant that we want to capitalize on. So in conclusion, we're taking a cautious view of the year in prospect, but we do remain confident in our strategy and future growth prospects. That is the end of the presentation. So let me just open up the Q&A. So Tom, if I read them out, some of them are relevant for you, some for me. Okay. So this is a question from Simon C. With a solid revenue line, what further operational levers do you have to drive the business to profit? Also, with a good cash position, are you looking at M&A? So M&A, absolutely. I think we've answered that question. Do you want to talk about any operational levers?
Yeah. So I mean, the way we've set it up, the business with the outsourced model, is very much our Project 50 plan is one to scale. So it's really scaling that revenue line, but with associated investment within advertising promotion as part of our strategy. But in terms of our cost base, obviously there are some elements that are variable in terms of logistics, and particularly with regards to direct-to-consumer marketplace. But it should very much be one where, as we are more successful with our organic growth, as we find the right complementary fits for mergers and acquisitions, that will result in effectively that revenue and associated gross profit having a great conversion rate down into underlying operating profit. So that will certainly increase our underlying or our operating profit percentages. And from a gross profit point of view as well, the more that we can push our brands, the more that we can be successful online as well and get good channel mix. Hopefully that means we can start driving our gross profit margins forward as well at that top line.
Thanks, Tom. Got a question from Chris R. Will the D2C platform be launching international post its initial launch to support existing international sales? So it's a good question. That's one of the benefits of working with the Hut Group Ingenuity division. So they're well established and taking essentially a UK D2C and putting it into multiple markets. So that is definitely the plan. We need to make it work in the UK first, but we see no reason why we can't take our portfolio of brands to multiple markets, but not in year one. But that definitely is the plan. With regards, lost that question.
Maybe go to answers.
Hi,
Alexandra,
I think you just deleted one of the questions. But if Imran K, if you could submit your first question again, that'd be great.
Well, I think I can remember it. I think the question is, what do we believe is the economic moat of the business being? How do we effectively maintain competitive advantage over others in our space, i.e. Crichton's?
Yeah, I saw that. I mean, I'm not going to particularly talk about Crichton's. It is a slightly different business, and Crichton's has its own manufacturing. And within that manufacturing, they also have hygiene products, which is not an area that we look at. It's not fair for me to compare our business. I think, we've got some very strong brands. We also now have a marketplace. They don't have a marketplace. But to answer the question about how do we keep ourselves relevant, it's about having a dialogue with the consumer. So we need to be aware of trends. We need to update our products to reflect those trends. We also need to listen to the consumer, whether it's from a packaging perspective, whether it's a formulation perspective, whether it's sustainable initiatives. So I think our strategy is strong and will help maintain our relevance for the future.
Yeah, and I think also the D2C marketplace is actually one of the factors of creating a moat for the business. Because, back to your point in terms of having that consumer dialogue is going to be key, something we haven't had before, but also what we've talked about in terms of having a masstige portfolio, being able to talk to those consumers about everyday beauty and giving us that data insight, but also a point of difference in the market. There are not many marketplaces out there that are targeting the masstige with their own in-house brands and British brands, Challenger Beauty British brands. So we believe that is a point of difference, and we're on that journey really to explore what that's going to do for us in terms of portfolio, in terms of M&A acquisitions and general business development.
Thank you, Tom. That's it in terms of questions. So, Alexandra,
thank you. Thank you for being very generous with your time there as well. I think you pretty much addressed all the questions for Investors Day, and of course, the company will review any further questions submitted and publish responses where it's appropriate to do so. Quinton, Tom, just before redirecting investors for feedback, I wondered if I could ask you for a few closing comments.
Yep. It has been a sort of a difficult year in terms of transition, but it's a fairly resilient performance, which we're pleased with. We're more excited about the transformational strategies that we've put in place over the last 12 months. If I was to summarize that, it's going to give us the opportunity to secure new distribution going forward. We believe we've addressed some of the weaknesses within the product portfolio, and we're very excited about creating a strong and exciting new marketplace called the Unexpekted store. Thank you.
Quinton, Tom, thank you very much again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, however, it's greatly valued by the company. On behalf of the management team of Brand Architects Group PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon to you all.